Jim, always good to see you.
Good to see you.
I think anywhere you look, people are stunned by how much interest rates have risen this year. Are you?
Yes, and I came into the year bearish on the bond market, but yet the returns that you've seen in the bond market are the worst in recorded history. This is going to go down as the worst year ever to be a bond investor. And it's not getting any better. What you saw today in the UK was the biggest rise in their 5-year note in history. It was up 51 basis points, 0.5%, one instrument in one day, which is an extraordinary move. You're seeing interest rates all around the world moving up higher, and it has just been something to sight to behold, even for a bond bear like me, to watch these kind of moves that we've seen in the bond market.
You know, we heard about an hour or so ago, Jeremy Siegel, the esteemed professor from Wharton, very critical, as animatedly as I think I've ever seen him, very critical of the Fed, and basically saying they're going too high, too fast, and indicating that they're going to stay too long without giving any sense that, they'll be sensitive to the idea of taking their foot off the brake if they begin to see a slowing economy, which he opines we're already beginning to see in some areas, most especially housing. What do you think?
You know, I think that's the problem. Why are rates continuing to soar? Because nothing is breaking yet. You had Savita on a minute ago, and she was talking about the consensus on earnings is 8% for next year. No one really thinks anything's breaking. Initial claims are falling. We've created 300,000 jobs in the last payroll report. So, yeah, we've got the FedExes of the world that are giving us some warnings, but by and large, everything's holding in. Now, what does that mean? In a world of inflation, rates can keep going, and that's what's bothering the market. When things start to break, yields will plunge, and then you'll know that we're probably near a low. So right now, we're in a scenario where good news is bad news. And as far as the Fed goes, I think the Fed is trying to make up for their mistake from last year. I'm as critical as the Fed, but I think their mistake was they didn't start raising rates last year. They waited way too long, and they're now playing catch up. And I also think the other thing that people have to maybe think about is this is a persistent inflation. This is not a one-time thing because we reopen the economy and then inflation disappears. It's ongoing. It needs to be dealt with, and that's what the Fed's trying to do. So, I think this is going to be a very difficult period for investors.
Jim, while the Fed has a dual mandate, the significant moves we're seeing across Europe, whether it's the stock 600 now trading at a 20% down from its all-time high, the UK pound at a 37-year low, bond yields spiking, as you pointed out, could that pressure the Fed from raising rates by 75 basis points at the next meeting?
Yeah, because it could break something. It could break something really bad. So the Fed wants to slow the economy to basically bring down inflation. The problem is, and I'll use a euphemism, there'll be collateral damage. That means other things will break too. And you have to look to Europe. I mean, it's so bad in Europe right now that the Bank of England in August did something extraordinary. They forecasted a recession. No modern central bank forecasts recessions, just like the Fed on Wednesday. They always give you some low growth number and they say that we'll skirt by with a soft landing. But they came right out and said that they're going to start a recession in the fourth quarter, which, by the way, starts next week. So they know that their economy is in a bad place. That's why they're massively cutting taxes and trying to stimulate, which is also bothering the bond market. All of that is a cocktail that could wind up causing a break something to break somewhere along the line that could alter the course of economic growth in the U.S., if not globally, and maybe get the Fed to change. But that's not happening yet.